future for intent-based protocols, or that's what we're going to see in the future, is a lot of, I shouldn't say centralized, but loose monopolies in terms of the actual auction, and then a lot of front ends competing to send order flow there.
And welcome back to another episode of the Talking Intentionally podcast. Today we have Ari from Axal, who leads strategy and partnerships, speak with Kinji from Messari. They talk about everything ranging from like how to value cryptocurrencies to, the future of generalized intents, which is right up Axal's corner. I hope you enjoy this podcast. Please check out Messari's research and be sure to follow along as Axal continues to build in the world of intents and solvers. I also want to remind you that right now our competition for creating the best trading bot on autopilot is still live. The winner gets $5,000. So be sure to check that out, and I hope you enjoy. Be well.
It's Ari with Axal. Today I'm with Kinji Steimetz, research analyst at Messari Research. Hey Kinji, how are you?
I'm doing great. Thanks for having me on.
Yeah, man. I think before we get started, we're going to dive a lot into intents, into chain abstraction, but would love just a brief introduction on yourself and some of the work you've been doing at Messari.
Yeah, sounds great. So I'm an enterprise research analyst at Messari, focusing on DeFi. Prior to this, I worked at Morgan Stanley doing crypto research. And before that, I was in Internet Consensus, which is how I kind of got into the space. On the enterprise research side, we basically focus on writing reports that express a protocol or a vertical that we're really excited about. So trying to put out a hypothesis, defend that hypothesis, and hopefully have that view be pretty differentiated. On DeFi specifically, we're also starting to do a lot of valuations. So we think that DeFi is mature enough now where the business models are clear. You have some good comparables to start to put these things into a model and get some fundamental valuation out of. So we've been spending a lot of time there. It's been going pretty well so far. I did a Morpho one saying 2 billion, and someone else Sunny did a Hyperliquid saying 13 billion. So for people who are interested in that, it's what we're doing.
We might circle back to that. I know the reason for this podcast, we like to talk intents and solvers, and you had two pieces that caught our eye at Axal. The first one being on chain abstraction, and the second one was entitled "Following the Value Flow in the Intent Stack." So we're going to tackle that first, but what you mentioned on valuations does sound super interesting. But first question, I want to keep it very high level. Why does crypto need chain abstraction in your eyes?
Yeah, so most people, I think, when we talk about chain abstraction, highlight three certain things. That being a better UX, aggregating liquidity, and then also kind of abstracting away decision making from users. So I align strongly with the first two, just the UX one and the liquidity one. So on the UX, I think it's pretty self-explanatory. We've all had the issue of trying to go across multiple chains, bridging, switching to, or toggling what chain we're on. It's a nightmare. And it was really highlighted to me when we had a bunch of interns come in over the summer, and most of them had never been on the EVM. Like they were only on Solana, only used Phantom, and trying to get them through that whole cross-chain EVM ecosystem was a nightmare, and you really had to hold their hands. So that's where I realized, okay, this needs to be solved now. The second issue is the liquidity fragmentation. So right now we have liquidity sitting across multiple pools, across multiple chains, and one that adds to the poor UX experience. And then secondly, it can also lead to worse execution if you aren't able to tap multiple of their sources and you're moving in size. So that's another issue that I think needs to get solved relatively quickly for us to move forward.
Yeah.
On the last one, I don't know if you want me to touch on why I don't think the decision abstraction is necessary.
Yeah, please.
It's mainly because, go ahead. Yeah, so when people say the decision abstraction, what I'm talking about is the idea of eventually a user won't know what chain they're on. They just know that they have stables. They don't know where it's held, or that they won't know what protocol they're using on the back end. They'll just know that they just successfully borrowed from some lending protocol. And I think when you look at what we're doing on chain, it's all very token driven. Like we want to buy a token, we want to borrow a certain token. And at the moment, most tokens don't have multi-chain deployments. Almost, I think it's like 65% are on one, maybe two chains. So I don't need someone to abstract away that decision, because if I want a certain token, I'm forced to go to a certain chain. Then on the protocol side of, what protocol am I using? Well, we don't have a whole lot of diversity in terms of actions that we can take. Most lending protocols look pretty similar. Most AMMs look pretty similar. And so we all kind of naturally gravitate to a single one. So In other words, I don't need to outsource my due diligence to some chain abstraction protocol. I can pretty easily just say, I want to do one action. I can look at DeFi Llama. Okay, this is the largest one. I'm just going to use that. So I think we need more token deployments and more diversity in protocols before that becomes a real use case, which I do think it will be, but I just don't think it's pressing at the moment.
Yeah, no, I appreciate that context, especially like the first point about just UX being a nightmare, especially for like beginners or newcomers into the space. In a chain abstracted world, who do you consider like the winners and losers? And specifically, does do blockchains become commoditized and that all users care about is speed? I feel like we're kind of seeing that in newer kind of newcomers just sticking to Solana. But yeah, in the chain abstracted world, how do you see that shaping out in terms of winners, losers, commoditization of blockchains? Yeah, would love your thoughts on that.
Yeah, so I think it depends on where you're looking at the stack in terms of where the winners and losers are. So I have like a simplified chain abstraction stack, which is just you have like the front end protocols. If you're using intents, you have the solver network and the intent auction protocol. You have messaging protocols, and then you have like the L1. If I were to, I don't want to go into every single one of those, but if I had to pick winners and losers out of that, I would say some of the winners are going to be the intent auction protocol. Basically, if you have a strong network of solvers, in my mind, that's the same as a liquidity moat. So if I want to do a cross-chain swap or I want to bridge, I'm going to go where there's the most liquidity. I can get the best execution, and that's going to be driven by who has the best solvers. So I think there's a moat there that can be defensible. On the messaging layer, I see them being a big loser, not because what they're doing isn't important and valuable, but I just don't think they're going to have any pricing power. So if you think of how does a messaging protocol differentiate, it's okay, I'm attached to more ecosystems than my competitors. But if you look at on-chain data, like 90% of what everyone does is across 5 execution environments. So all those webs are going to look exactly the same. Also, another way you could differentiate is I have better security than the other messaging providers. I don't think users care too much. I think there's like a minimum threshold that you need to meet. And once you meet that, any greater security you have doesn't provide extra utility for the user. So, and I'd assume all the ones that we end up using in the end are going to at least meet that threshold. So I don't think they're going to have pricing power. Specifically to the L1s, L2s, I don't think chain abstraction changes a whole lot for them. So I think we have high throughput or transaction speed and cost is important, but everyone's moving towards that goal. So that doesn't change the vision. I think you're also competing on getting the most liquidity on your chain, which in my view is driven by getting more applications developed on your chain. So people deploy tokens, people want to bridge to use those tokens, et cetera, et cetera. And that's also like the exact same model that they're going after right now. So yeah, I don't see it necessarily leading to a commoditization. I think the moats that L1s are developing now or L2s are going to be exactly the same with or without this chain abstraction feature.
Nice. A common criticism of solver networks is the fact that they're somewhat centralized or kind of forming these oligopolies. If you look across CowSwap, Uniswap X, and for a decentralization purist, that might be seen as like a bad thing. I mean, what's your general take on that?
Yeah, I'm definitely not a decentralization maxi. Like I want things to be as decentralized as possible. So I think when you take that view, it's how decentralized can market making really be? Because I think when we talk about decentralization, it's mostly doing market making features. It's my view that market making is inherently opinionated. So if you're going to be market making, you have to have a view on, whatever your time horizon is, where prices are going to go. And that's something that's sophisticated. We probably need specialization there. There's some economies to scale with it. So I think you naturally get some centralizing forces. So I don't think we can avoid that in crypto in general. Like if you're doing anything on chain, swapping any assets, chances are you're hitting Wintermute at some point anyways. So I think it's already happening. I think the thing that we need to keep in mind to be successful is making sure it's easy for any competitor to enter that space. I don't want the winners to be entrenched just based on regulatory moats or something like that. I want it to be anyone can come to the space and participate, and I think that's where decentralization comes into play.
Yeah. A second criticism is solver networks are essentially an alternative to AMMs. Do you see AMMs going away entirely? Do they perhaps shrink as solver networks become kind of a greater part of the market? I know MEV is a big problem in AMMs. But yeah, just kind of very complex space. Wondering your take there.
Yeah, we've been thinking about this a lot, and we don't have a really strong answer. We kind of have some frameworks going though.
Yeah.
So I think in general, the order book model is superior, right? Like AMMs came out because of gas constraints. They didn't come out because it was a purely better model necessarily to trade major assets. With that being said, like the huge unlock I see with AMMs is the fact that anyone can deploy them and anyone can have liquidity fairly quickly. Like you don't need that market maker to come make. So I see it as the very long tail of assets will always go on an AMM and start. Once you reach a point of critical scale, then a lot of that price action or a lot of that volume is going to move to an order book, whether that's on chain or off chain. And we already kind of see that playing out. And then I think the question is what happens to the AMMs that are hosting major assets. So like an ETH USDC pool. And there's a lot of talk about LVR there, which is something that Intents can help mitigate by batch auctioning off, or auctioning off using a Dutch auction to have a unified clearing price like CowSwap does. But I think the question is how much are LPs willing to take on toxic flow and how big of an issue is that? And it's my view that we should just be giving LPs as much flexibility as possible to express their views. So if you have a situation where an LP thinks we're going to be in relatively we're going to have low volatility, meaning LVR will be lower, then might as well AMM, eat that toxic flow. I won't lose that much money. If you think there's going to be high volatility, particularly in one direction, then you're going to eat some toxic flow that might be negative to you as an LP, and you might want to go into a CowSwap AMM or maybe just pull your liquidity as a whole. So I don't know exactly how that's going to play out. I don't think AMMs are going away at any time, but what their role is in the future, especially for major assets, I think is an open question.
Yeah. Switching gears slightly, you wrote a paper called Following the Value Flow in the Intent Stack. So for those who haven't read it, or maybe, it's very eye-catching title, what is the value flow in the intent stack in your eyes?
Yeah, so I think to get to that question, you have to kind of think of where does value come from in a transaction. I like to split it into two parts. It's just the fees that a user is willing to pay for execution. So that's what like Uniswap and gas fees are going to be. And then there's this or I shouldn't say untalked about, there's this intrinsic value, which you can really think about as being MEV. So if I'm creating slippage, there might be some arbitrage opportunity, that's value. Right now, that intrinsic value is mostly being captured by validators on the Ethereum L1 because people are doing gas auctions. Essentially, an alternative way to think about that is the order flow is a commodity. The block space is the scarce asset, so I have to bid on the block space. Yeah. And intents are flipping that so that the order flow becomes the scarce asset, which means that it can be captured by some other user, not the validator. So we see value at the flowing through the front end captures most of the fees in terms of like what a user is willing to pay for execution, maybe split with someone on the back end. And then there's this new layer, the intent stack, where the solvers sit and an auction protocol sits, and they're going to capture most of the intrinsic value. And they have the option to distribute that back to the user. So my view is they won't have to do a whole lot of that because of those liquidity moats I talked about a little bit earlier. So they'll have some pricing power to keep it. So it's really moving the MEV from the validators to whoever's hosting an auction.
Yeah, I actually really love that framework. Yeah, so order flow becoming the scarce asset, and then the front end capturing the fees, and then of course the solver networks. Are you seeing any like good examples of that today?
Well, I think you look at most intent protocols. Like that's basically what CowSwap's doing. I don't know if their fee switch is completely turned on yet, but they're experimenting with taking some of the surplus that was coming from limit orders. I think that's a fantastic model. That's what I modeled in that piece that we're talking about. So I wouldn't be surprised to see more trading-based applications experiment with intent-based front ends or intent-based settlement, I guess. So I think Drift might have announced they're going to look into that, and we'll start to see more value going away from validators in terms of MEV and moving up the stack.
Yeah. Do you see a world in which all value kind of is captured by these front ends and solvers, not necessarily validators?
All value? I wouldn't say all value because you still have to pay for compute, you still have to pay for data storage. So there will always be a market there for the validators to take on. It's just what are the triggers that are, or what are the things, let me rephrase, what actions are we taking that kind of leads to that value flow back?
Yeah, makes sense. And
I don't
then
know if that made sense, but
no, no,
yeah.
it did, it did. And a big kind of like point in the second paper was intent-based system reduced protocols to glorified front ends is what you call them. Is that essentially, can you go into that concept in more detail? Is it essentially there's this shared backend of solver networks for, all protocols? Did I summarize that correctly, or yeah, how do you see that?
Yeah, so I think that summarizes it pretty well. I think so. Some topics are around, do we need like a general purpose intent framework or intent platform versus more specialized ones like a cross or cow swap, kind of focusing on a particular use case. I kind of lean towards the latter. So I think what we're going to get is one or two intent-based protocols dominating order flow for a particular vertical, and then what their job is to try to get front ends to feed that order flow into their auction protocol. So I think you can see across doing that a lot with the kind of the upgrades they're proposing. Basically, that makes a standard so any front end can easily send order flow to a cross. And so if they dominate that standard, they can dominate that vertical. They don't have to build the front ends themselves, but they're still going to get a lot of order flow coming in. And so I think that's kind of the future for intent based protocols, or that's what we're going to see in the future is a lot of, I shouldn't say centralized, but loose monopolies in terms of the actual auction, and then a lot of front ends competing to send order flow there.
Yeah. So you mentioned across or like cross chain swaps as, being dominated by one or, winner take all, winner take most kind of market. You also mentioned general purpose intents. What are as intents kind of goes away from, limit orders or like cross chain swaps, where do you see that market heading next? Where do you see users like utilizing intents for what types of tasks?
Yeah, that's a good question. I think that's like a long term view because most of what we do is just trading or just swaps.
Right.
So I think there's opportunities for you to build more complex structured products on the back of an intent. So maybe if we want to do options, alternative types of futures contracts, you could do that through an intent protocol and let the solver kind of figure out how to price that and how to hedge their risk in other venues. So that's one opportunity. I think lending you could also do. So auctioning off the interest rate, things of that nature. In my view, though, the general purpose intent platforms, we don't have enough complexity in on-chain actions to really justify the need for those at the moment. Hopefully that changes, obviously, where we have all of finance happening on-chain, and then you might need some more general purpose intent engines. But until then, I don't think it's absolutely necessary.
Yeah, makes sense. Maybe shifting a little bit away from intent frameworks, solvers, chain abstraction. What else currently excites you in the space right now?
Yeah, great question. I think I spent a lot of time looking at perps and lending. So Sunny, he's another analyst at Messari, DeFi Monk on Twitter. He did a Hyperliquid report, and we're excited about that because we think basically perps or order books only work on app chains. I don't think you can have a or an order book that sits on a general purpose chain because if I'm a market maker, I need to be able to prioritize my cancels, which you can't really do in a general purpose environment. And also, if I have to pay gas on every single order I place, every single order I close that doesn't get filled, that's going to add up. I'm going to have to widen my spreads, and it's just always going to be a worse execution than going to an app chain where you can tailor those parameters. So we're excited about Hyperliquid and just the app chain thesis in general. I guess another thing I'm excited about is modular lending. So I think if you look at like incumbent lenders like Aave, they basically, the thing I don't like about it is all depositors have to adopt their risk profile of the DAO. I can't create my own custom one versus the modular lending stack allows you to do that. So we're also excited about that there.
Yeah, you mentioned Hyperliquid. In the very beginning of this podcast, you mentioned your valuation research. There's such a I mean, speaking for myself, there's a large disparity between cash flows, kind of how you would value a traditional business versus token value. Like, what frameworks are you applying? Like, you can't do a traditional DCF. I would assume, I could be wrong, but like, what frameworks are you using to value, different projects today?
So yeah, we usually take. I agree, you can't do a DCF. It's going to be impossible. It's going to be hard. It probably won't be relevant. But what we do is we look for tokens that we think kind of act as equity in a certain extent, to a certain extent. So we see a avenue for them to eventually distribute value back to token holders. And then from there, it's really forecasting top line revenue and take rates. So it's pretty simple. And then you're able to get to a revenue number. And then you can, because DeFi has enough diverse protocols, you can start to pick out, okay, what multiples do I think make the most sense here?
Yeah.
And so it takes some practice and it takes some understanding of what are the levers that go into pushing up revenue or pushing down revenue for this particular protocol. And can I take a view on that?
Yeah.
But yeah, hopefully that answered the question.
No, it did, but it starts with mechanism design. And is there value capture even happening to the holders? Like, sometimes you see, I think the industry is getting better at it, but sometimes you see like, we're going to launch this token that's complete bolt-on, not a lot of utility. So you kind of have to start from a qualitative perspective first. Is that right? Like, hey, does this token even make sense? Is there somehow value going to the token holders? Is that like the starting point, kind of a binary yes or no before you start looking at revenue metrics?
Uh, yes and no. I think we'd want to choose tokens that have that value capture. But I think if you look at the way the market moves like it expects all of them to have value capture.
Yeah.
So I mean, if there's one that blatantly is never going to turn on a value capture thing, we probably won't want to spend a lot of time there because that's not a secular winner in our mind, at least in buying and holding that particular token. Uh, but that doesn't mean that the same framework can't be applied. Uh, Hopefully that makes sense. It's like I might not write a report about that, but if you wanted
Yeah.
to build the model, then you probably could. Yeah.
Taking on a completely like TradFi persona for a second, are crypto markets so irrational that it's impossible to value? You look at whatever, Spark Coin, any example like that. That would be like a hardcore, TradFi maxi, I suppose, stance. But to what extent do you think that's true in your valuation work?
Uh, well, I'm not going to value a meme. That's impossible. That's a vibe thing. But I think when you look at DeFi and you start to build these models, you realize they are fairly rational. The markets, like I will do my revenue forecast, right? I'll throw my assumptions in. They'll be based on some historical numbers, yada yada yada. And then usually when I throw on the multiple, that's maybe Aave's trading at or some other blue chip DeFi assets trading at, you actually get to a number that feels right. And a lot of times, if you compare it to where is it trading, it looks right too. So they're surprisingly rational. I think a big reason for that is because we had liquid funds move into the space and they're investing in that way. And we haven't had like a huge rush of retail coming in looking to buy these blue chip assets. So it's a much more sophisticated user base, or I should say holder base now, which helps kind of normalize those things.
Yeah, that's fair. No, I think it's really important to differentiate between kind of revenue generating protocols, something that's or apps, something that's adding value, and yeah, just you can't value vibes. I think that was a quote. But going to the going back to Hyperliquid, you did a lot of research there. What in terms of their TGE did you like? Did you not like? A lot of people are saying like this is the model for future TGEs, kind of low VC funding, high community like kickbacks. Like what are your thoughts there? Is there a change? Is it just like, hey, they were just able to do that given the fact that they given their fundraise? Yeah, how do you think about that?
I think it's more the latter that they were able to do that. Obviously didn't have VC funding, so they could have a much higher allocation to uh, points holders. So I think it was like 30 something percent. We're not going to see that in other tokens that are VC backed. Also, I think you have to acknowledge it starts with the product. Like they built a fantastic product that a lot of people are using. Um, so if you don't have the product, if you don't have a great product, it doesn't matter how much you're airdropping. It doesn't matter if you have VCs, like no one's going to want that token anyway. So I think it's kind of this super sweet spot where you have something that works, something that's fantastic, a team that people really like, and then you also had that bonus of no VCs. That leads to generational wealth for a lot of people who were trading there.
Yeah, no, definitely. So, anything we missed? We went from chain abstraction to solvers, generalized intense frameworks, and valuation. I feel like it was a great, yeah, your commentary was great. I really appreciate your time. Anything you missed that in your research, like, hey, this is something I'm excited about. I think people should look at. Yeah,
No, I mean, I love intents. That's the main thing I want to do, and I want to do valuation. So we covered on my specialties and what gets me excited. So it was a great time.
awesome. Where can people see more of your work?
Yes, so definitely subscribe to Messari if you haven't, and then you can find me on Twitter at Steimetz Kinji.
Cool. All right. Thanks so much, Kinji. Appreciate your time.
Yeah, thanks for having me on. Really loved it.